Hello everyone, Luis here with Contreras Financial. In this video, I'm going to be talking about the tax advantage retirement accounts for businesses, the simple IRA, SEP IRA, and also the 403B, or also known as the Tax Sheltered Annuity. So let's get started. Okay, so I'm going to be talking about the simple IRA first. Now, technically, there's two types of simples. There's a simple IRA and a simple 401k. But the simple 401k I'll talk about in another video. And all this information is as of 2021. Again, you know, if tax laws change in the future, then I'll do an updated video on that. But for right now, all the information that we'll talk about is as of 2021. So for the simple IRA, what type of businesses can do this type of plan? Almost all types of businesses. For-profit businesses, S Corp, C Corp, partnership, LLC, sole proprietor, as well as self-employed individuals could do these plans. Also nonprofit organizations, charities, foundations, possible school districts, hospitals, nonprofits overall can mostly do these plans, as well as local, state and local organizations and governments, and religious organizations as well can do these plans. So what is the eligibility for the employers, or what I put here, ER? So for the employers, they have to have either equal to or less than 100 total employees. The employees need to be making at least $5,000 in that current year, and no other retirement plan could exist. So no pension, no defined benefit plan, no 401k or anything else. The only exception is possibly a 457, but I'll get into that in another video. But most of the other plans, no. For the employees to be eligible to even participate in this plan, besides making $5,000 in the current year, is that they have had to have been your employees for the last 2 years, and also have earned $5,000 or more in those preceding 2 years. So how much can they contribute, both for the employees and the employers? So for the employees, they can contribute all the way up to $13,500, 2021, and if they're 50 years or older, they can put in an additional $3,000. Now for the employer, they have to choose one of two options for matching. They could either do a 2% eligible employees matching. So every employee that's eligible, they have to put in 2% for them. A fly. So even if you have employees that are not participating, meaning that they're not putting anything into an account, you still have to put in 2% for them because they're eligible for the plan. So that's one option. Or you could do what's called a matching employees up to 3% for those employees that are actually participating in the plan. So if you have, let's say you have 100 total employees that are eligible and only 10 of them decide to participate in this plan, then you just have to match them up to 3% for those 10 that are participating. So that's one. Two, if let's say these 10 employees are only putting in 2% of their income, then you just have to match them those 2% for those 10 employees, because this is up to 3% matching for those. So so it's only those employees that are putting in money, and you'll match them only up to 3%. So if that employee decides to put in 10%, those 10 employees decide to put in 10% of their income, you just have to match the first 3 and you're done. That's it. So a lot of employers like this in case they have employees that don't want to participate. They like the second option. So one or two that you have to pick. Vesting. So what vesting means is that when are the funds that have been contributed to these plans, when are they the employees? Immediately. Both the employee contribution and also the employer matching. It's immediately all of the employees. So if you have employees that leave to another company, those employees will be able to take all the funds, including the growth, with them at the time that they resign, or that they get fired. They're able to take everything up until that point. Now, one other note I need to make is that these plans, all the contributions are pre-tax, meaning there is no Roth contributions, there is no after-tax contributions. So if you're looking for a plan that has that ability to make those contributions, this is not it. These are only pre-tax contributions. So save taxes on it now and then pay taxes on it later. What are the tax benefits of this plan? So for the employer, they're able to deduct their matching contributions. And the great thing about this one is that the employers are able to deduct their contributions all the way until they actually file their business tax returns. In case they haven't made any matching contributions prior to that, they can still make them until they do their tax returns, but it will be deductible. For the employees, since this will, of course, will be deductible for their income, and usually the payroll company, a lot of payroll companies, you can set it up automatically so that they take it out of their payroll, every time they payroll is due. The funds also grow tax deferred, so that means that there won't be any taxes to be reported on any gains per year. So they're able to take advantage of the long-term growth of a tax deferral account. Taxation and retirements. So whatever the employees at that time take out of these accounts will count as ordinary income for them. So only on the amount that they take out, not the whole thing. So what are the investments that are available in these plans? So almost all types of investments are available, except only a few of the exceptions for IRAs, like I think it's like stamp collections and certain coins and things like that aren't able to be invested in these accounts. But almost everything else, stocks, bonds, mutual funds, ETFs, index funds, annuities, you name it. You could do these in these plans. For the investment responsibility, the employees are the ones that are in charge of these plans. So it's up to them to manage it. If they don't feel comfortable, they can usually get an advisor like myself or somebody else to help them manage the account for them, so that it takes the worry and stress off of them to manage it. Retirement certainty. This is of the benefits I'm talking about. It's uncertain because it depends on the performance of the investments in each account, and also how much contributions were made. So it's uncertain because of that, of those two things. And the costs for these plans, they're very low. So that's a beautiful thing about these simple. They're low, easy to administer. There's not a lot of testing to be involved. There's almost nothing actually of testing. As long as the employer just does one of the matching, they just have to pick that and they're done. They don't need a certain amount of employees to participate. There's no annual testing and all this other things that have to be done, or certain reporting. It's all easy and low cost to do. One disadvantage to this plan is that in the first 2 years, the early withdrawal penalty is a little higher. Instead of 10%, it's 25%. So yeah, just watch out for that. And usually, because of that reason, no rollovers could go into these plans. Meaning, for example, if you have IRAs or retirement accounts from previous jobs at another place, and you start this plan, or you're employer starts this type of plan and you want to roll it over, usually you have to wait 2 years until you're able to roll over those funds into the IRA because of that, of the higher penalty, the 25%. Yeah, so hopefully this gave you guys more information on the simple IRA account. And yeah, if you have any questions, just let me know. Hey guys, just want to make a quick correction regarding the simple IRA before we move on. In terms of rollovers, you could make rollovers from another simple account. It could be another simple IRA that you had, or a simple 401k. Those are the only ones in the first 2 years that you're able to roll over. Outside of that, the first 2 years, you're not able to roll over any other type of account. So just want to make that clarification and that correction. So now we're going to be talking about the SEP IRA. So number 2, SEP IRA. Come on over. Alrighty, so for the SEP IRA, to be eligible for it, almost again, all types of businesses can do this. For-profit business, non-profit organizations, state and local governments, as well as schools, hospitals, and as well as religious organizations. These organizations, it could be any size. There's no minimum and no max. It could be 5 people, or it could be 1,000 employees. So no size limit. For the employees, for them to be eligible, they have to have had at least 21 years of age or higher. Have had to have worked 3 out of the previous 5 years with you. And in terms of income, they have had to have made in those years at least $650 or more. So out of all the plans, these plans have a very low income limit. So as you can see, $650 for the whole year. I mean, that's very little. But as long as they make that, have worked with you 3 out of the last 5 years and 21 years of age, they're able to qualify to participate in a SEP IRA. For the contributions of a SEP IRA, now again, these plans are what's called discretionary. Same thing with the simple IRA. The employees for the simple IRA don't have to participate if they don't want to. For here, the decision is made out of the employer, because all the contributions are going to come out of the employer. Everything comes out of the employer. So employees do not make any contributions at all. But it's up to the employer to decide whether they want to do this plan or not. Now the same percentage of contribution that the employer decides has to be for everybody. So if they're going to put in 5% for the business owner, they have to put 5% for all the other employees. So it's all the same percentage for everybody. The max contribution that could be done into these plans is either 25% of compensation or $58,000. So whichever one is less. So for these plans, the contribution can be higher than the simple IRA. Again, it depends on each individual and their situation. One other thing I forgot to mention is that self-employed individuals could do these plans as well, and this seems to be a favorite for self-employed individuals because this plan is easy. It's only them, so they either have to put 25% of what they make or $58,000, whichever one is greater. The vesting schedule, so as soon as money is in those plans, it's the employee's money, so immediately it's vested. Tax benefits, for the employer, the contributions are tax deductible. There is no tax deduction for the employees because they're not putting anything out of their own pocket. It's all coming from the employer, so it's deductible, and the money grows tax deferred as well. Now this plan, similar to the simple IRA, only offers tax deductible or pre-tax contributions. No Roth, no after-tax contributions at all. So what that means is that at retirement, the money that is withdrawn is all taxed at ordinary income. Again, the investments available are similar to the simple IRA. Very few exceptions, so mostly everything else, stocks, bonds, mutual funds, ETFs, index funds, annuities, mostly all of them, real estate as well, you could do. Investment responsibility, for these, it's usually the employees as well, unless they get an advisor to help them. Retirement certainty, and this is based off of the funds in this account. Well, it's uncertain because it depends on how well the employee manages those monies in the account, and as well as how much contributions are being made for the employee. So for these plans, the employees should see and should check out how much contributions are being made so that they could plan and maybe if they have to open up another type of account themselves, do their own contributions elsewhere if it seems that it's not enough for their own needs. The great thing about these plans is that, again, they're very low cost and easy to administer. They're they're discretionary, so the employer doesn't have to do it. They could do it for a couple years and then stop and then continue it, a couple years later. So there's no mandatory funding. So this is the SEP IRA, all the information there. So now let's dig into the last plan for this video, the 403B, or the Tax Sheltered Annuity, as it's also known as. So come on. So the 403B Tax Sheltered Annuity. So eligibility. So for these plans, you have to be either a nonprofit or a religious organization. So those are the only two types of organizations that can do these plans. In terms of size, it could be any size of employer, and it must be available to all employees. So all employees would be available for this plan to be able to participate. Contributions. So another fly, not going away. So for the employer, for the organization, they could either do a matching or contribution or not. It's discretionary, so it's up to them. They could just say, you know what, we're not going to do any matching, we're just going to offer it to the employees and that's it. So it's up to their choice whether they want to do some type of matching contribution or not. For the employee, generally the employee could put anywhere from 0 to about $19,500 a year max. And also, if they're 50 years or older, they can put an additional $6,500 a year. And all these numbers are, again, as of 2021. Now, for those that are, 50 years or older, there is what's called a special catch-up contribution in these types of accounts. So the employee, not only do they have to have the age of 50 or older, but they have to have worked for the employer at least 15 years or more. With that same employee, they may be able to make even more contributions. It's a little more complicated with that, but I just want to point it out to there that they could potentially make more contributions on top of the $6,500 and the $19,500. So pretty substantial amount of contributions that can be made. Another great thing about these plans is that they both usually offer both pre and after tax contributions. So not only could it be tax deductible contributions, but it could also be Roth contributions or after tax contributions as well. So these plans do offer that. The vesting, meaning when is it the employee's money? Immediately. As soon as they put in their money or there's any matching, it's immediately the employee's money. The tax benefits, again, for the employer, if they do a matching, it is deductible. For this one, for the employees, it depends. If they do pre-tax, then it'll be deductible. If they do a Roth contribution, then that is not deductible. They pay the tax now, and later on they'll pay it. It'll be tax-free if it's eligible distributions for them. Money does grow in the account tax deferred, so either way, pre or after tax, money grows tax deferred. And taxation at retirements, well, I guess should probably put depends here. Sorry about that. So again, it depends whether the employee's money was pre-tax or after-tax contributions, because they may have a mixture, some taxable and some not. So it depends on there. In terms of investments that are available, so for these plans, it's usually only mutual funds and annuities. So no individual stocks, no individual bonds or ETFs. It's usually just mutual funds or annuities that are available. Investment responsibility, it's the employees. The employees are the ones that are in charge of their account, so they manage it. Retirement certainty, it's uncertain because it depends on how well the employees manage their investment performance, as well as if they made enough contributions to be able to build also the size of that of their account big enough to be able to live off of the investments and the gains of those investments. The cost for these plans is generally from low to medium. So it can be a little bit higher depending on the matching and the size of the employer, but usually these plans, they're very similar. If you notice the information, they're very similar to a 401k, but they tend to be a little bit lower in cost than those types of plans because there's usually less requirements, less testing as well. More than the other plans, the simple and the SEP, but usually a little bit less than a 401k. So anywhere from low to medium, that's where the cost point is at for these types of plans. So yeah, this is the 403B Tax Sheltered Annuity. So before we conclude, please check out these next couple of slides for some very important information. So that does it. Thank you so much for watching the video. If you'd like to subscribe to my channel and support me, it should be on the on this bottom right hand side. I don't know where, but somewhere over here is a button to subscribe to my channel, so you can support me and I can continue doing these videos. And also, if you would like to, if you like the video, please hit the like button. Thank you very much. Remember that the more you know, the better decisions you'll be able to make. God bless. Bye.